please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
What an eventful week, and what a week generally it has been for both Bulls and Bears. It's been a week for the Bears, absolutely. You're with us here on a fresh new edition of Taking Stock, and there is a fair bit to take stock of. But we also will look forward, as always, here on this show in terms of what the coming week could hold for all of us. I'm Prashant Nair. With me is my colleague Surabhi Upadhyay. Hi, Surabhi.
Hi, Prashant. Yes, what a week it has been. I mean, I was just thinking Friday to Friday, and unfortunately, we aren't too much better off compared to last Friday and when the mayhem entirely played out. Anyway, let's just quickly run through some of the key features of this week gone by. It's been a heady bear cocktail, you can really say that. Because what we are saying is that, this is a market that has fallen 4 out of the last 5 trading sessions. So Monday was a buy day, but after that, it was just one way and that was down. Now, what are the ingredients of this cocktail? Number one, this entire issue with liquidity tightness and what's been happening in the credit market, IL&FS, is there a bigger default ahead? What is happening to NBFCs? Is someone giving money to NBFCs or not? That has been the dominant theme in the market this week. Not just this, oil prices have been elevated anyway. They've been flirting around that 82 mark, so that doesn't work too well for us. Rupee continues to be a lingering concern. Thankfully, it's not fallen more this week. Thankfully, some of those import curb measures, at least they arrested the decline there. But then the market had other bigger issues to deal with. Coming back to the liquidity point, and really that's been the talking point of trade. So this entire saga playing out about NBFCs, what is interesting to note is that on Thursday and Friday, rates started easing up in the money markets, but that did not help equities. It did not help NBFC stocks. In fact, we saw the Nifty breaching the intraday low, the Friday intraday low on Friday, this Friday. Then there was a quick short covering recovery, so we managed to close slightly higher. But levels are really sort of coming and going in this market. That's what's going on. If I talk about some of the stocks, then Yes Bank has been a big news point, and again a news point for the wrong reasons. That stock's down about 19%. The selling continued. Post-market, we got some statements from Rana Kapoor saying he's not selling his shares. Let's see if that assuages any of the concerns. The other concern in the market now is festive season and particularly auto sales. So one key highlight again is the weakness in auto stocks. Maruti, Tata Motors, or even if you're looking at Eicher Motors, these stocks are down between 9 and 13%. These are large index stocks that we are talking about. In fact, the only really pillar of hope and strength in the market this week was IT. That to very specific large cap IT names, because mid cap IT is correcting. Infosys TCS did all right, and Reliance saw some buying as well. The bigger problem in the market is what is happening to mid caps. We've had a couple of very vicious days for the broader market. Friday included big swings, big falls. The casualties like Infibeam down about 70%. I just want to pull up NBFC since we're talking about what's happening in the big sort of in the broader market. Stocks like DHFL, Shrey Infrastructure, even an Edelweiss, or even an Indiabulls Housing Finance. Just pull up the intraday, the intra-week or the week-to-date performance. The cuts are deep. We're talking anywhere between 10% and 22-23%. So that's the extent of the NBFC fall, which really hasn't stemmed. And if you go beyond the NBFCs, and again, KPIT Technologies, Jet Airways, Gen Irrigation, lots of names on the downside. I could go on, but let's not waste more time just taking names because we know these are the weak trends. And Prashant, what we've essentially seen is the lack of any kind of conviction coming back or confidence coming back. Essentially, at least in the equity market, bears are just having a field day.
I think the critical word is confidence, and I think you can add one more word, which is crisis of confidence. I mean, which is basically what it is. So sheer panic across the board. And I spoke to a number of, funds. I mean, I spoke to a couple of foreign funds as well, specifically on the point of Yes Bank, for example. And everybody is just actually asking the question back, which is, what have you heard? I mean, so this is, I don't remember this kind of a view or lack of view, and still this huge selling that we've seen in a long time. Actually, I don't remember the last time. Otherwise, stocks fall. I mean, there is something which is out there, the numbers are showing it, or something is there. But in the case of the way Yes Bank has fallen, I mean, it just, it's in a way scary, because we are still awaiting. So what is the next step for Yes Bank? What is the market fearing? The market is fearing that Mr. Rana Kapoor was maybe he was asked to go because there are going to be more divergences which are going to be reported for FY18. I mean, if you go by last year's schedule, that is, divergences came out in October of 2017 for the previous financial year, which means that, we're going to hear about any potential divergences October, which is the coming month. So many people I've spoken to said, well, nothing is going to happen before we actually see the divergences coming through. If it is small, if it is large, and then people will start to take a call. But for now, it is just completely fear factor. Let me get out before the price is down a little bit more. I think that is the... and. Let me tell you, prices like this don't fall because of some shorting and derivative market action. This is, cash selling, institutional selling, which is clearly sort of happening out there. And of course, the NBFC thing we've been talking about quite a bit, but there, I'll get to that. I'll get to what's happening there in just a bit. But look at the damage. I'm taking the change from last Thursday because Friday was a big fall. So from Thursday's close, Yes Bank is down 44%, Indiabulls Housing is down 27%, DHFL is down 55%. The big question in the case of NBFCs, which people are asking is, if AAA rating is not sacrosanct, what should we do? What should we as investors do? And I think, a company like Indiabulls, for example, is going out there, and I think they issued a release also saying that we are one of the, 4 or 5 NBFCs which have got the AAA rating. And obviously, it's something to be proud of. But the point is, if AAA can go to junk overnight, what is the value of AAA? The other thing which is happening is that, so some have the AAA tag, but maybe the market doesn't perceive them to be AAA. They may see them as less than AAA. So there, people are again sort of don't want to take a chance, and that is the reason why the selling is happening as it is. But I think we need to focus a lot more on this rating business in terms of how can AAA go to junk without anything in between, and I mean some warning. How can rating agencies and particularly one in this case get it so wrong? Still no clear solution to the IL&FS meeting, stakeholder meetings, etc. are going on. Maybe we will hear something later today, maybe over the weekend. But that is another big problem which we are still dealing with. I mean, I usually start with this big global picture, etc. But I don't think that is really relevant here because it is all local, and I think that next week as well it will remain local. Just one last line: the global picture. I mean, you go through equities, yields, dollar, everything. I mean, it looks pretty benign. It looks pretty supportive, I would say. Except maybe oil, which refuses to come off. And from a global perspective, oil is the one which is the big spoil sport. Otherwise, I mean, quite okay. The issues are very much local.
Oh, absolutely. Completely take that. All right, so let's straight away get to our guests on the show. Joining in to discuss a lot of this mayhem that's played out and really what lies ahead, we have with us Harsha Upadhyay of Kotak Mutual Fund. Harsha, good to have you on the show. Thanks for joining in. Congratulations, by the way, to you, because we know that Kotak Mutual Fund got the Fund House of the Year award at this year's Mutual Fund Awards. But, coming down to some of these harsh realities that Prashant and I have been discussing, do you get the sense that we're anywhere close to the bottom of this panic and this mayhem?
Thank you, Surabhi. First of all, I think we really can't say that the bottom has been made in the short term, simply because the panic is still there. I mean, we have seen how the markets reacted today. Whether it is overdone or not, only time will tell. But I think at the moment there is no stability as such. It all started with the credit event that happened at IL&FS, and slowly the debt market froze. The liquidity squeeze has led to questions about the funding ability of many of the NBFCs, which are over the period of time have been heavily relying on MF flows to fund their liabilities. Now, with the stock price fall and the entire negative sentiment surrounding NBFCs, there is also a question mark about some of the asset qualities in some select NBFCs. So given all this, I think it's very difficult to say that in the short term we have made a bottom. But I think as increasingly the volatility increases, market corrects further, I think there will be opportunities for long-term investors. And as institutional investors, that is what we will look out for as we proceed.
Okay. Harsha, so let me, without naming names, I know you can't talk about specific names. Is it about, taking to NBFCs, is it about cost of funds going up? Because housing finance companies don't have that big a spread. So, so there is the doubt whether they can pass it on effectively and stay competitive and all those kinds of things. Access is also an issue. But is it just about that, or are people now starting to question whether the asset side of the balance sheet is also kosher, whether there are issues there? How come these guys built up books so fast, so quickly, so large, so quickly?
Prashant, that's what at least we have been saying in all our interactions earlier, that the growth has been almost uniform for almost all NBFCs. And it can't be so uniform with uniform asset quality, and there will be some issues of asset quality at various levels. Having said that, I think right now the scare is coming only because of the liabilities side. Over the last 6 or 8 quarters, most of the NBFCs were relying on short-term funds, especially commercial papers, and these were funded by mutual fund industry. And now the question is whether there will be rollover of these commercial papers going forward, and if it is rolled over, at what cost those will be rolled over. Because of these issues where there is no clarity as yet, and given the freeze that we have seen in the market, seems like all of them will not be able to get a rollover at the prices that they want to. There is going to be an increase in cost of funding, and that's going to put pressure on the margins and the business profile of some of the companies, at least in the NBFC sector. And it usually happens. I mean, any cycle, whenever you see interest rates moving up at various levels, you will see pressure coming on NBFCs. But this year, I think clearly NBFCs, despite increase in interest rates overall, were not showing any fall in valuations as such. So to that extent, while the interest rates were going up, while the risk was building up in the industry, the valuations were moving up. And that is what has led to this sharp correction, apart from the negative sentiment surrounding the credit default and the cascading impact that it could have on the NBFCs. But as far as we are concerned, we haven't seen any asset quality issues as such until now.
Okay, so I was just trying to understand how you are sort of tweaking, if at all, your own stance. If old valuations are not going to come back after this reality check, then sort of will you stay away from housing finance companies? Would you only look at consumer finance? How are you now sifting through some of the NBFC holdings that you have?
Surabhi, thankfully we were underweight on NBFCs. We didn't have many NBFCs in the portfolio, and the ones that we have in our portfolio are very strong franchises. We do not believe that they are going to get affected in any way, even if there is a scare in the market or funding constraints in the market. They are all well capitalized, well funded NBFCs. So to that extent, from a portfolio perspective, I think we are quite insulated from what has been happening in the NBFC segment. But I think given the fact that the petroleum prices have risen so much and there has been a hole in consumer pocket, clearly the consumption was anyways going to take a hit. And given the fact that the lending to finance some of these consumer discretionary spends would also possibly go down over the next few months, there seems to be some bit of caution that is required on the consumer discretionary and the consumption-oriented businesses. And that's where I think we have seen significant volume growth over the last few years. And also we have seen significant stock performance. And that is a segment that we are looking to cut our weightages. Apart from this, I think on NBFCs, we are fine across all our portfolios.
Okay, that's a real portfolios. Okay, that's a really interesting juncture. Looking to go slightly perhaps underweight or cut some exposure on consumer. Harsha, we're going to get back to you on that point. Just stay with us because we have some news coming in right now. Let's just quickly address this. I could explain why, of course, the Indian hotel stock was up and about in such a downbeat market. The Tata Group has managed to retain the Taj Mansingh, the iconic property in New Delhi. Let's straight away go across to Anshu Sharma, who has all the details. So a long slugfest, but the Mansingh remains with the Taj Group. Anshu?
That's right, Surabhi, and this was the fourth time that NDMC, New Delhi Municipal Corporation, tried to auction this property to the bidders. It had to relax some of the criteria, and at the end, only two bidders came in. That was IHCL, Indian Hotel Company, and ITC. But we understand that Indian Hotel Company has won the bid at 32.5% of gross turnover. That will come to about 65 crore annually that the Tata Group company will have to pay up to retain this property. This is a 292-bedroom, 5-star property in the central Delhi. It's an iconic property as a 5-star hotel, and we'll have to see how soon this deal will be signed by NDMC with Taj Group. Back to you.
All right, Anshu, thanks very much. Appreciate you taking us through that story, and we'll, of course, get you more details as and when we get them. Back to markets, and Harsha Upadhyay of Kotak is with us, and we've been in conversation with him. Harsha, so what else are you sort of doing away from this, NBFC financials kind of pack? Where are you finding opportunities, if any? Also, at an aggregate level, do you see maybe another 5-7% downside as far as indices themselves go?
As I said initially, I think it's very difficult to put a number in terms of where the short-term levels would be for any of the indices or any of the capitalization baskets. But I think clearly the kind of overvaluation that was there on mid caps and small caps as compared to large caps at the beginning of the year is no more there. Yes, from a historical perspective, they are still slightly above large cap valuations or around large cap valuations. Historically, they have traded at a discount of about 15 to 20%, at least until 2014. And the entire situation changed post 2014, wherein they started trading at a premium, and that premium peaked somewhere in January 2018. As far as today's valuations are concerned, on a relative basis, there is no clear sense of which segment is likely to be more attractive than the other, simply because while mid caps and small caps have corrected to lower levels, they are still above their historical own levels. And also the large caps have not really corrected in the entire mayhem that we have seen this calendar year. So to that extent, I think one will have to be more stock specific and sector specific. As far as we are concerned, I think over the next couple of months, if correction continues, I think we will start nibbling more at mid and small caps. But there will be no aggressive buying of mid and small caps yet.
Harsha, to go back to the point that you just raised, that you are getting cautious on consumer stocks and you're looking to cut weights. Valuations are high, and I get your growth concerns. So now, how are you going about it? Are you downgrading staples? Are you moving out from there? Are you staying with discretionary? How are you going about this pruning of the consumer holdings?
For the last couple of months, we have been selling consumer discretionary stocks, especially auto and other consumer discretionary stocks, because of the fact that after a long period, we saw some fatigue in terms of volume growth, and also there were raw material cost pressures that were building up. And we also noticed some inventory that was getting built at the automobile dealerships. So that was anyways going on, and the fact that now the funding that comes from NBFCs to these sectors will also take a hit, at least in the short term. I think that view will prevail, and we will continue to reduce our holdings in some of those names. As far as staples are concerned, we really don't see that consumption is going to get affected by what is happening in the NBFC sector, at least for as far as staples are concerned. But the concern really there would be of valuations. Valuations which are very high from their own historical perspective, as well as from a market relative perspective as well, they're quite high. So to that extent, they don't give you any kind of defensiveness anymore, and especially after having seen such large sectors, it doesn't make sense to go and buy consumer staples once again at these valuation levels. So to that extent, we will continue to moderate our overall weight in both consumer discretionary as well as consumer staples.